more room to ration even more demand? The guy to answer these questions and several other questions is MIke Zuzolo, the one who was right about the wheat rallies this week. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, I think you were right about the wheat rallies. There was some significant rallies in the previous week, but I would like to jump into the question about the rationing demand. Some analysts are saying that there is a lot of room for many other increases. Do you see room for that
Increases in demand, you means,
in
Louise?
prices?
In prices, excuse me. Well, first of all, thank you for the compliment on the wheat. You know, as we say up here in the United States, a stopped watch is right twice every 24 hours. So it's nice to be right about the wheat. It's nice to see a supply-driven market and get some weather premium pushed into the wheat market. And on that note, Luis, I think we're still really in a supply weather driven market at this point. In other words, I believe in the weekly export sales, I think support this, that we have been rationing demand at these higher price levels. I'm getting a much stronger sense that end users, whether you're talking about hog feeders here in the United States or hog feeders over in China, I'm getting a strong sense that they're going to really fight to keep their demand trimmed at this stage until we become safely planted, or unless there is an issue during the planting season here in the United States. And I think we need to go back a couple months and think about what we've been talking about. And we started out, you and I together, during the COVID spikes and the beginning of COVID, and we talked about a summer driving season and a summer grilling season. And now we're a year into it, and I think that we are seeing more conclusive evidence and more medical opinions surface that, other than the mutations that are still unknown and uncertain in the medical field, we are seeing dramatic reductions in COVID hospitalizations, and we're starting to see a real nice downtick in COVID deaths. So how does this tie into the grain market? How does this tie into the supply chain? If we go back a few months and we think about what the end user and the supply chain was doing, they were buying extra. They were trying to hoard extra grain, hoard extra meat, because they didn't know if they'd have the labor to be able to, in a couple months, to be able to keep their supply chains going. I think we're unraveling that now. In other words, they'll be less likely to jump into getting extra bushels of grain, extra pounds of meat. And it makes sense economically at these price levels as well. So why I don't know if this weekly export sales reductions that we saw, we know China reduced in cotton. We know they reduced in beef because USDA told us that, but we also had meal reductions, wheat reductions, corn reductions, bean reductions of unknown destinations. I think the trade's assuming that's also China. I don't know if they're going to keep doing that, and we can talk about that in more detail if you want, but I think this is a weather supply driven market. And I've told clients as late as this afternoon before I jumped on here with you, we can go, in my opinion, to where we were in 2008 of almost $17 new crop beans. We can go to $6.50 or $6 new crop December corn, but I think it's going to have to be a weather event here in the United States or an even more significant one in China or Europe to get us there. So it's not going to be demand led at this point. I think it's going to still be supply led.
Yes, you mentioned the summer driving season and the summer grilling season that we were tirelessly talking about last year, but it never came. But the estimates for the U.S. economy during the second half of the year are very significant. Goldman Sachs is forecasting a growth, an economic growth near to 7%.
Mm-hmm.
So what would happen to those commodity prices if we have all the U.S. adults vaccinated by by the middle of the year?
And I'll throw some dry wood on your fire, your theoretical fire. And that is in the course, this is brand new news. In the course of 2020, rich countries threw out $18 trillion worth of debt, and 80% of that was below 1% to be able to keep the global economy going during COVID. That was real money, and it's in the real economy. And that's a different dynamic than what we had after the financial crisis. We had a lot of Federal Reserve movement and a lot of bank movement to keep the liquidity going, but we didn't let the money into the real economy very much at all after that financial crisis. This time around, the market is rightfully concerned about the inflation. And I think we got to keep thinking about that inflation doesn't just come and then go. It just doesn't come and go. It tends, once it sticks for a long time. And I think this is where the investor mindset may be more favorable to the hard assets like gold and silver and commodities in general and land, and harder assets as we see these major bond yields and interest rates in the real marketplace go up and stay elevated. And that keeps them interested in the commodity markets longer than what maybe we're used to. So I think this is a dynamic where you're going to have high gas prices to start off the summer driving season. You're going to have high meat prices. USDA just came out last week in their ag forum and said US beef prices at the retail level are 10% higher than they were last year, 8% or 6% higher for pork and poultry. So we're starting off with much higher prices than we were a year ago, and people aren't making that much money. So this pushes us back into, in my mind, a more 1970s, 1980s type inflation. It's not wage driven. It's not wealth driven. So it's not demand pull driven inflation. It's more cost push inflation where wages stay stagnant and all the prices go up for the goods. And that's a very tough time and a very tough way to manage and market in the commodity sphere. So we really got to be nimble this year, I think, because we could see very big price spikes if weather comes in, but then those price spikes may go away very quickly, and they may come back again if there's another bump in inflation on the macro side. So I think it's going to be really, really hard to get producers and ranchers to stick with a hedging program this year.
And you can get one clue on what would happen with Brazil and Argentina once there's more people vaccinated. If you look at Chile, that has more than 20% of its population vaccinated, with a very high price of copper. It's a very big copper producer. The Chilean peso has got very strong recently. And do you agree that this would happen with Brazilian and Argentinian currencies against the US dollar?
It's very possible, but we're not there yet, I don't think. In fact, I think it was just today the Brazilian central bank came in and defended the real because it weakened again, and I believe it's now back to the weakest point against the dollar since the middle or later part of November of last year. I've also seen the Chinese yuan come in and take out a trend line of support, and it's now starting to weaken, and I think it's at a 2 or 3 week low now as of today's market against the US dollar. I think at the genesis of this market for the inflationary mindset, as we've already discussed, has also been put together with the emerging markets. And that's what traditional financial investment people look at, is if emerging markets are strong, their currencies are strong against the US dollar, and therefore the commodities tend to be strong because those are the countries that really demand the commodity, have the commodity demand in them if their currencies are strong. So if their currencies weaken, that then is taken as a sign that their commodity demand is going to weaken. And Chile is kind of an exception because it's a major copper exporter. If copper were cheap right now, it would probably be in the same situation as Brazil or Argentina in fighting against a very strong US dollar. So I think what we're talking about is probably a longer term or medium term analysis. But I will continue with my clients to suggest to them, if the emerging markets weaken and we don't see the dollar weaken with them, then we will assume that the commodity investors are going to pull back and that they're going to take off some of their long commodities. And it may only be for a couple, 3 months, but that's going to be an important amount because that's going to be right in the middle of our marketing plan.
Well, in that darker scenario, I would like to ask you why for the second half of the year the corn prices are lower, and that is not happening with soybeans and wheat.
Yeah, this is where I think the corn continues to be underappreciated by the marketplace. And a lot of this goes back to the negative sentiment by a lot of my colleagues or other grain analysts that are not satisfied with how much corn the Chinese have taken, have literally physically loaded on ships and have it over in their ports. Their sales are strong for the US corn, but the demand in the physical market and the actual export inspections are not keeping pace nearly as much as what they have been in the soybeans. So when the US and the grain analysts in this country are looking at the supply demand sheets, they think there's a lot more likelihood that soybeans are less than 100 million bushels and we are razor thin. We have literally no carryout left to export. Whereas with the corn, we're not in that situation yet. And so until we see the trade realize that, and USDA, I think, helped propagate this mindset last week with the idea that we're going to have 92 million corn acres planted up here in this country. That was much bigger, 2 million acres more than I thought we were going to see by the USDA, the United States Department of Agriculture. So I think this is where what I'm telling clients right now, Luis, is the key to the downside in this market is the soy meal. Because if Brazil is late on their harvest, that means they're going to be late getting beans over to China. So if beans don't get to China, Chinese meal prices go back up. And if Chinese meal prices go back up, Chinese hog prices go back up. And if Chinese hog prices go up, their pork prices go up. And China can't tolerate that in terms of going back up to those levels. I think they're still up over 100% versus a year ago in their pork price at the retail level. So if the meal market stays above that January low of $417.60, I think the market is solid. Why do I feel like beans are the weakest out there? Because I think the supply side is the biggest for the beans. And we saw that again with the Reuters Newswire report, where they put out the estimates for the upcoming WASDE report in another week or so. And 12 out of the 13 analysts polled said that the Brazilian crop was going to be over 130 million tons. And the average trade guess was almost 133 million tons. I personally don't see it that high. I can't see it that high with the La Nina weather we're seeing and the quality of beans that they've so far harvested. But if we have that kind of supply, we don't have anything close to that kind of a supply coming from the corn side of the equation in South America, especially I think Argentina, and especially that safrinha corn in Brazil. So my point being, if the beans stay elevated and November beans stay at $12.25 plus a bushel, why isn't December corn at $5 a bushel? Because I think it's going to take that to get the December corn to get to that price, to get the farmers to move to plant those many corn acres. Otherwise, I think the bean acres are going to outshine the corn acres when producers look at their input costs, their cash basis, and just their net selling price. And this year, because of higher volatility, higher crop insurance prices.
Yes, and I would like you to dig deeper on the Brazilian factor. We saw recently that some trading companies are threatening to sue some Brazilian farmers because they are threatening to not deliver contracted soybeans. And yet, I saw that one specific state, is reducing slightly the soybean production. That is the state of Paraná in their own state agency. And what I read from an agro consult crop tour is that they jumped the state of Rio Grande do Sul, because the state of Rio Grande do Sul, which was the worst affected by the drought, but the state harvests soybeans by the middle of March. Just start from that point. So wouldn't make any sense for this specific crop tour when Mato Grosso starts the harvest much earlier.
Yeah, I think you hit a really big point here because we don't know because things have been delayed for the whole crop year in Brazil. I mean, Argentina is easier to figure out at this stage, but for Brazil, it's just too difficult to know what that size of that crop is because we're so far behind and have been ever since planting. So I'm trying to mitigate that by just watching essentially the meal price at the Board of Trade because that tells me what the funds are doing. And now that the March meal goes into delivery as of tonight, in terms of our recording, by Friday morning, we will be the March soy meal futures will be a cash contract at the mercantile exchange, and so we can get a very good idea in the next 20 days of what the actual physical price in Chicago is of meal, and we can get an idea of also how many beans are still left out there by producers and how much the market can bid up to get those beans from the producers. So I think we'll get a lot more information in the 15 to 20 days here with the function of the market at the Board of Trade Mercantile Exchange. But as far as Brazil goes, the other thing I got to watch is the Paranagua port price. I think that tells us everything. And it was going down with the Argentine interior price here the last week or week and a half, but it has shot back up again and recovered about $6 or $8 a ton of its prices. U.S. Gulf of Mexico beans are still about $25 a ton, $20 to $25 a ton more expensive than Paranagua. But if we've got crop issues like rain delays and quality issues and government farmer issues, we're going to see that in the Paranagua port price, I think, first. And so I'm going to use that as an extremely valuable kind of canary in the coal mine, Luis, that if we once again get to a point where the Paranagua price is above the Gulf of Mexico price here in the United States, I think China will be looking for beans to spot in that they can't get from Brazil the month of March.
Yes, and I can tell you that it is very likely that during the harvest, uh, there will be a lot of issues, political issues, because the price of diesel is very high for Brazilian truckers, and they have been threatening for a long time for a strike. And Bolsonaro, who is a pro-market kind of guy, very similar to Donald Trump, sometimes go nuts and intervenes very strongly in the market.
Yeah, this is where I think we have to appreciate the idea that price spikes can come, but listen to what you and I are talking about. It's once again a supply driven price issue. It's not necessarily demand issue. Yes, China still wants the beans, but they really don't want to pay for them at these price levels. No one does in the global marketplace. But what you and I are talking about are supply side issues, and those tend to not last very long. And they tend to do a lot of damage, especially in the grain markets, because especially with the variety of substitutes that we can have or cutting back on animal weights. Typically, my rule of thumb with commodities is once the demand is lost, it's gone forever. And that came from some of the old time agricultural economists that I really looked up to 10, 15, 20 years ago. I think it's still a good rule of thumb because either the end user finds another place or he finds a cheaper conversion, or he goes ahead and changes his feed rations and lightens up on his weights, and that demand goes away because he's forced to make it go away. And I think that, and then they may not be able to do it completely, but they'll work very hard to not have to pay up if it's a supply driven issue. And so these are the kind of mechanics that we're working through in 2021. And in the same time, this, what you're talking about with Bolsonaro in Brazil, is a currency related issue that will affect the US dollar and Brazilian real. And so it also comes back around and works into the macro side of the equation. And that's what I realized 20 years ago when I started to really get into my value level analysis was the macro and the micro are interlinked. You can't separate them. They work together because all these emerging markets stopped having fixed exchange rates. They started to float their exchange rates or have a peg like China does, where it's a certain range. But that opens you up to currency fluctuations, and then that changes everything, especially among major competing countries like the United States and Brazil for soybeans. One last point, I don't think that Brazil will expand that much in 2022, especially given what I'm hearing by some of these other private analysts. I believe there is a consortium led by Europe that is going to work very hard in not buying Brazilian soybeans if it's Amazonian rainforest cleared Brazilian soybeans. So I think we're at a point now, climate wise, that you're going to start seeing an influx of big money trying to change how we essentially produce beans in Brazil. And I think that could hit as early as 2022. And you bringing up the diesel prices, that's another reason why producers are not going to stretch hard and push hard, because the low hanging fruit is gone at this point. All their costs and input prices are skyrocketing. Why would they push so hard to get so little of a return of investment?
Well, and if we get a record crop in Brazil, those things are only getting worse because there is more demand, pump demand for transportation, but the trucks are the same, the number of truckers are the same, and the oil available in the world is the same. There's no increased production.
No, and you've only got a certain number of deep water places to put those ships to be able to load and unload. So this is where your infrastructure catches up. This is where your supply chain catches up. And at the same time, if we're coming out of COVID, you're going to have a global end user. And I asked this question of some of the bigger players at the Ag Outlook Forum last week. I asked them directly, and they answered me very honestly, and I was really appreciative of it. I said, is the just-in-time way of doing business over because of the pandemic and what we saw in the supply chain? And they said, unless the consumer, the customer, is willing to pay more, they are not going to increase their costs, and they're going to go back to just-in-time because they have no other way to do it unless the consumer takes the added cost of having and holding extra supplies and inventories. That was a big piece of the puzzle for me about when we do come out of the COVID and the pandemic, is what can change here? Well, not a lot when it comes to our supply chain.
Well, on the wheat side of things, I checked some updates from the USDA for some specific wheat producing states, and they have improved slightly from the previous crop progress report, but it's still it seems to be a complicated crop this year in the United States.
Yeah, and I'd say I was surprised by the monthly update in Illinois and other soft red wheat states of how much the crop had declined versus the prior month. And so I would offer two suggestions to the listener and the viewer. We are still in a weather market. We still need to put weather premium into the market if we stay dry and warm. And it looks like in Kansas and Oklahoma and most of Nebraska, we're going to stay warm and dry for the most part of the first half of March. The drought monitor is still very much an issue. We have to remember that states like Minnesota, South Dakota, Nebraska, North Dakota all have 100% drought right now of some form in their states. And last year at this time, all of those states had 5% or less, 5% or zero drought in those same states. So we still have a very big issue to have to contend with when we break dormancy, and that's right around the corner. So weather premium, number one, needs to stay in this market, in my opinion, unless the dollar comes in and really starts to shoot higher. The second thing would be, I think we're on the verge of losing even more winter wheat acres, both west of the Mississippi and east of the Mississippi, given these crop conditions and given the fact that we hit $12.25 in November soybeans this week. That, when you can get 80 bushel beans with these new extend varieties, I don't know why producers would not tear up wheat that looks pretty rough and just plant beans, and even do it without crop insurance. So I think we're still on a pathway of more bean acres versus more wheat or corn acres.
Yes, and I saw some news wires coming from riders saying that the corn acreage would increase in China. Have you seen the same report?
I have, and I'm dubious of that, Luis, because the reason they weren't able to produce that much more this past year and last couple of years is because they just haven't had the quality of ground to produce it on because they're utilizing that land for other areas and or other uses, and it's not farmland anymore. And so, my suspicion is that document number one that they published about really going back and increasing their self-sufficiency and safeguarding their supplies. That's all well and good, but it's probably not going to happen for the next couple 3 years.
Okay, I would like to go on the livestock sector. You have been telling us that you think the second half of the year will be the better for livestock producers. But I would like you to tell us what you think, how devastating it will be if this inflation really steams up and takes over. I think would be devastating for livestock producers, a lot more concerning than the soybean or corn growers.
You're very much right on that. And my only hope is we have had times in the past when we have tight grain stocks and we have reductions in slaughter level of animals and smaller number of inventory of animals. If the grains rally, the livestock prices can rally with them. And I'm hopeful. I think that will happen this year. If we do have another drought, that will put the animals in jeopardy as much as the corn and the beans. And I think they can both go up together. And so that's kind of out in the June, July, August time period, Luis. But what we've noticed in the short term and why the cattle market was able to rally, other than the strong surge in the stock market price, which I think we may be topping in that stock market. We've talked about this. I think we're starting to see signals of the stock market wanting to maybe put a top in for the time being. And that will be, if that's true, that will probably be a negative influence on the cattle market in particular. I'll put that to the side for a minute. The other key point, though, with the short term is what happened in Texas and the potential loss of the herd in Texas and cattle, especially, is starting to shape up, in my opinion, as something similar to that derecho that happened in the corn crop in Iowa this past year. We may have lost a lot of supply in Texas. We just don't know right now, but that I think has certainly come in and helped support these cash prices finally, and also really support the futures prices. Doesn't mean I don't hedge. I'm still a hedger, but I'm respectful of the upper parameters and trading ranges of the April and the June fat cattle prices. But when I get up to those upper levels, I'll still put hedges in place I've already got them in place for the second quarter. I'll go ahead and move towards the third quarter of hedging too.
I think the headline for our show could be "It's not time for euphoria."
That's exactly right. It's going to be tough but because we've outlined how this happened in the 70s and 80s where companies thought they were making record profits, but they weren't adjusting for inflation all their costs, and they actually were taking a loss even though they were making record revenues. Their costs were going sky high, and I think that's really an issue we have to work with with our grain producers and ranchers.
Thanks a lot, Mike. Have a great week.
Thank you, Luis. Great conversation as always.